So to come to the basics of investment, or making money, there are multiple avenues. If you see, I copied this from somewhere: real estate, or bonds, stocks, mutual funds, futures, etc., etc., etc. So why option strategies, or why options? Because real estate is like investing in a small cap fund or small cap stock. You wouldn't know which would boom and which would not. So sometimes it gives you 2x 3x within a short span of time. Sometimes it never grows after you invest a significant amount of money. And the other options like stocks, bonds, everything depends on a lot of fundamental technical analysis. And those were not very attractive to me, because I was not able to identify the direction. And whatever stock I buy will go down, whatever I short sell will go up. So I got out of these directional plays and moved to option strategies, where whatever let the market do, I would adjust to it and try to make whatever little bit money that comes out of it. So that's the reason I got into option strategies. And the beauty of option strategies is you have hedging options. You can construct a payoff structure, and you can have a peaceful sleep. You can have, even with overnight positions, with completely hedged positions, you can even have a peaceful sleep. So that is why I chose option strategies. And for a consistent income with defined risk, I think, to my best of abilities, I found this to be the best investment vehicle for me. And I hope the group here also would second my thought. So that's how we got into option strategies. So let's go to the next slide. Basics of options. So as far as most of you know what are the basics. So just to touch up, it was created for hedging a portfolio. So large investments, large players used to invest a lot of their funds into stocks, like mutual fund houses, life insurance companies, and all those large houses. So to hedge their portfolio from sudden fall or any crash, they used to buy put options to hedge the portfolio. And they do by beta hedging. So they calculate the beta value of the portfolio, and then they hedge with relevant stocks, or maybe index which is forming the portfolio. So that is how the hedging, that is how the options thing came in. But later on, people started making money out of options, and it became an instrument of itself, though it goes along with underlying behavior. So that is how options came into play. It is then, let's see what is buying and selling options. So buying options is the best thing to do for someone who is excellent in identifying the direction and momentum of a stock or an index, or any instrument, so that you can buying needs very less capital. You can buy, and when you are right in your decision, it gives amazing returns, unlimited profits theoretically. But most of us who tried that must have failed in scaling it up, or we wouldn't have that courage to go large scale into buying, because identifying direction and momentum playing against theta used to be a difficult play for most of us, or for me. So that is how we chose option selling. The default known fact is that the premium is getting decayed as days pass by. So that is for our advantage. So that's how option selling became prominent in the last 2-3 years, and we are one of them to gain that as a consistent income for us. So let's know about key option Greeks. If you look at key option Greeks, people think that it is really Greek and not understandable. And if anybody talks about Greek, they say this guy is going to cheat you by saying all jargons, etc. But I really find that to be successful in options trading, we should know the basics of Greeks, so that when something goes against us, say 3 days back or 4 days back, both call and put were increasing. So a person who did not know Greeks would not understand why it is behaving opposite to the way it should behave, right? So then there were some experts in the group said IV is rising. So IV is nothing but Vega. So to give a quick short description about the option Greeks, the first Greek is delta. Delta, the second Greek is theta, third is gamma, and fourth is vega. There are other couple of Greeks like Boma and RHO, etc., which doesn't impact much in our option pricing, option premium pricing. So delta is the place where delta is the place of options that the value of options that moves along with the underlying. Say ATM option is 0.5 delta. That means for every 1 rupee movement in the underlying, the option ATM option will move 0.5 into 1 rupee, 50 paise for every 1 rupee move. But it will not remain 50 paise for long, because if the market is moving against you, the delta would be coming down from 0.5 to 0.4, 0.3, and that 0.543, all that is decided by gamma. So delta, if you want to understand delta is the rate of change of price of the option depending on the underlying. Theta is the amount of premium that would be getting decayed or reducing from whatever it is from the starting time. So that is called theta, and this is our friend. We always play for theta. Gamma is the rate of change of price of the option in line with the underlying. So how fast the delta changes. So a 0.5 delta changing to 0.4 or 0.6 will be slow on Friday and Friday, Monday, Tuesday. It would be very quick on Wednesday and Thursday, because the play is very limited, because the it is close to the expiry. So that is why mostly we say gamma is a hulk on expiry days. A 3 rupee option would go to 300 rupees and expire 0. So for somebody who sold 3 rupee option will get a heart attack if it goes to 300, right? So gamma is a very risky, very risky Greek when it comes to Thursdays. That is why in most of our strategies we moved the strikes to next week, so as to get ourselves protected from gamma hulk. Vega is the volatility. Vega denotes the volatility of the market, of the instrument. So VIX is for index Nifty, and for Bank Nifty, VIX is partly reliable, but Bank Nifty has its own IV. I am searching for IV tracker for Bank Nifty, live IV tracker for Bank Nifty. I couldn't get. If any of you get, let's keep that also, so that we can exit positions if IV is rising in Bank Nifty. So that's about Vega. So how Vega will play against us is our option selling strategies are short Vega. So when the VIX or the volatility comes down, we will make money. On the other hand, if the volatility or VIX is going up, that means the prices of the option premium is going up. So it will be against the theta. So when Vega is strong, it will beat theta on Friday, Monday, Tuesday. Wednesday and Thursday, theta would be more supportive for us. So this is about option Greeks, and knowledge required to succeed in options trading. So the knowledge I thought is just to construct option strategies and keep adjusting as much as possible, and beyond a level, adjusting is also waste of effort and time. We should just exit and move on. So we do not need knowledge of indicators or technical knowledge or candlesticks or how the market will behave. We don't have to predict, right? So if we have to predict, and if we are successful in predicting, probably we should go with option buying. We will, it will make more money. But since we could not predict the direction, and most of the time when we predict, we go wrong and we lose fighting the battle with the market, I decided that option selling, neutral or non-directional option selling is apt for me. And if the market picks up direction, I will adjust and go along with the direction. And I use very minimal technical indicators like RSI and pivot points, etc., which is just to meet my emotional tensions, etc. Otherwise, by algo design, it should work by itself. All these are inbuilt, and that's how it should work. So can we go to the next slide?
Hey, someone might have a question. Somebody's raised hand, so I don't know if they have a question or something. Can you just open up?
Okay, so how do I see more? Okay, there are some chats that has come.
Chats are generally what somebody has raised hand.
Yeah. Any questions?
I think let's continue then.
Yeah, let's continue. Next is the popular option strategies. So, in Zero the Varsity, there is a huge, resource there explaining each and every option strategy. And, those are more theoretical, and we may not use all those or many of those. We primarily use 2 or 3 or 4 option strategies. And in those 2-3 strategies, we make 10-12 variations. So that's how we try to make money. So let's see what are the long-term and positional strategies that could be helpful for most of us in this group, and what are the short-term or intraday strategies that we can work on. So cash secured put for people who wanted to invest in a share and waiting for the right price to invest, probably can go for a cash secured put. Say it is nothing but selling put options for the preferred price at which you wish to buy your stock. For example, if you want to buy Reliance at 1800, okay, and you are expecting that it would come down to 1800, and when it comes down to 1800, I would invest maybe 500 shares. So for such kind of investors, you should either invest at current price, maybe 2000 rupees or so, or you just wait for it to fall to 1800, which never happens when we expect, right? So such people what they can do is they can keep selling 1800 put option of every month. So if the price is coming down to 1800, you could take delivery. And if it is not coming down to 1800, if it expires above 1800, whatever amount you sold the put option for, that is your profit. So even if it is 10 rupees, you sell it for 10 rupees every month, you make 5000 rupees of selling that option. So the total investment for selling stock option would be about 3-4 lakh rupees, right? So that is one way, and that will help in over a period of time. Sometime if it comes to your price, you could invest your money into the stock that you wish to invest. Second is the covered call. This is for people who already hold stocks in their portfolio, and when prices fall significantly, the portfolio price comes down and we do not know what to do, right? So a simple method for this is, whenever you have stocks, say it would work if the quantity is as good as a lot size. So probably you can sell 5% or 4% or 5% ahead, whatever call option is 5% ahead of the current price every month. If you start selling it, as long as the stock doesn't breach that level, you make that money. Say if you sell your options for 10 rupees, every month you make the 10 rupees into number of quantity. So that becomes a rental income for the collateral, rental income for the stock that you have. Even the stock that you have, you could pledge it and get the collateral margin. In the collateral margin, you can sell this. So net, you don't have to bring in any extra money to do this. So if I know many of us in this group do it, but any of you are not aware of this and you have a good amount of portfolio, you could do this. In case you do not have the quantities in line with the lot size, probably you can look at finding out the beta value. How you can do it is, if the stocks are of Nifty 50 nature, if they are from Nifty 50, you could probably short the Nifty itself. Nifty 50 call options can be shorted. There is a formula and Excel tracker. I found it in some website. Probably we can exchange that, and you could find the value of how many lots to short. And it doesn't require additional money because you can pledge your holdings. So that is covered call. Third is leaps, long-term options. People play in long-term options in the US, and in India we do not do because we want to see things faster. So the one of the better options for somebody who do not have time and wanted to get things going automatically, probably every year start you could probably sell a ATM put option or slightly OTM put option of December month. And in Nifty, even 12 months ahead, you will find liquidity. There'll be very slight bid-ask ratio mismatch, but still it is fair. So you could do a ATM or a slightly OTM put option sell and leave it for the year. After 6-7 months, if it is in good profit, you could simply square off and go for the next 12 months, maybe next year, June, or every quarter, quarterly Nifty options will be liquid, and in the multiples of 500 it would be liquid. So that is one way to do. For a very not so active trader, this can be one option. So these are long-term options that we can look at. Then we can do monthly calendar spreads, ratio spreads, iron butterfly and iron condors. So when it is positional strategies, mostly I would prefer iron butterfly or iron condors. We call iron fly. So the reason is it is protected in both downside and upside. Otherwise, it's not advisable to hold overnight positions without hedging. You never know. Maybe 2-3 years profit can be wiped out in one black swan event if we have a large position of unhedged positions overnight. So spending a little bit of money for hedging is never a mistake. We should always look at hedging at least the downside always, if it is positional or if it is positional positions. So let's now come to short-term or intraday strategies. This is what all of us are actively participating at. Short straddles, short strangles, calendar spreads, ratio spreads. Short straddle is nothing but selling call option and put option of the same strike, and it can be ATM short straddle or a different strike short straddle. I mostly work with Nifty and Bank Nifty. I have not. I've explored stock options, and I found it to be very difficult because during the last week, it becomes. There will be a ban, or the margin will be increased by the exchange or by the broker, and you have to take delivery if you don't, and it becomes illiquid when it goes ITM. Most of the even the good stocks, good stock options also becomes illiquid when it goes ITM, and some of the stocks get into ban. Then you can't exit at the price that you want. You have to surrender to the market. So such things, a lot of things which are unfavorable are there in stock options. Therefore, I move to index options. Index options is always liquid mostly, and you can exit or enter at any point of time and any volume or any quantity. Nifty is less in terms of slippage. Bank Nifty is tough, but it is high risk, high reward. So that is how we move to index options. So I was talking about short straddles. The idea of short straddle and short strangles is selling call option and put option, which is not at the same strike. So it could be 1 or 2 or 10 strikes away from current price, selling call options and put options. So the idea of short straddles and short strangles is that we do not know the direction of the market. When you draw a payoff diagram in Sensible or Opstra, you will find the boundaries up to which you are safe. So in an intraday basis, the entire boundary cannot be considered because the T curve will be a little lesser. Still, since we do not know the direction of the market, we go with short straddles. Short straddles are safer than short strangles because when there is a very heavy movement, the delta will be increasing very fast in the losing side than giving profit in the winning side in short strangles. Whereas in short straddles, it is close to the ATM and the premium is quite high. It would manage the delta move as well. So I think Pratik had mentioned this point well in the chat group. And third option is calendar spreads. It is nothing but selling a near-term option and buying a far-term option. It could be this week and next week, or this week and this month. So probably you can sell ATM put off this week and buy ATM put off this next week or this month. If you sell put, then you expect market to go up. If you sell call, you expect market to go down. So some people do both. So that is calendar spreads. And the next is ratio spreads. Ratio spread is nothing but buying one call and selling two call options, say buying ATM call option and selling two OTM call options, or three OTM call options. So buy and sell will be in a ratio. It is also called as ladder spreads or something. So these are the options that we can use. So calendar and ratio is somewhere it requires the directional bias. You should know what direction bias you're taking and then enter into this trade. Otherwise, short straddles and strangles are good for us. So let's go to the next page. So I thought we will discuss about in today's discussion, we will talk about straddle, some of the straddles that we do, and many of us know these, but let me still emphasize on what we do. So the first model of straddle is we have a fixed time of entry, maybe 9:20, which is the most popular straddle, and many people in Twitter make fun of it. But really, if you look at it, it really gives a decent ROI. The strategy is like this. We enter straddle at 9:20 or 9:30, 9:45, 10, whatever is the time we are comfortable with. And then we fix a stop loss at each leg. It could be 20% onwards. Less than 20% has given bad results. 20% to 40% has given decent results in the last 2 years backtest. So maybe I keep 25% stop loss in each leg. So what happens is when Bank Nifty starts, when the market starts at 9:15 and we enter at 9:30, and between 9:15 and 9:30, the opening range is formed. The first 15 minutes of opening range is formed. And then if market breaches one, say if it continues going up, most of the times, maybe around 60-70% of the times, it would continue going up. Or if it goes down, it would continue going down. If the opening range is not broken, it would be within the range for most of the day. So that is how this short straddle strategy is becoming a little successful. So what we could do is enter the straddle, put stop loss in both the legs, and forget it. So if market goes one side, the losing leg will exit and the winning leg will continue till the end of the day. And if market reverses, both the legs get SL hit, then that is a loss day for us. So this is the first strategy which can be explored. The second strategy is really working out during these days, during May and June, where market goes 200 points up, 200 points down, and then up and down. It is not trending upside or downside, maybe except for 1 or 2 days. So in such kind of situations, this second strategy would be good, where you define a strategy level stop loss. So first is we take a straddle, and probably if you want to keep a stop loss of say 2,000 rupees or 3,000 rupees per day, so that translates to say 80 points or 120 points. We keep so much points as our stop loss. So as long as market is within that level, we make money, and this is pure theta expectation or pure premium decay expectation. If market goes one way, any side, we lose on that day. Whereas in the first strategy, if market goes one side, we make money. And if market goes up and down with the volatility, then we lose on such days. The third short straddle can be on a rolling up, rolling down basis. I have I've got strategies for each of these types and listed in marketplace. I will explain if it is interesting. So roll up and roll down basis, how we do is we take a straddle and say if we keep stop loss and profit booking of X percentage of the price. This is price action based, or we can even keep at a number of points basis. Say for example, we sell call option and put option for 200 rupees each, and we keep 50% as the stop loss and 20% as the profit booking. So what happens is, if market is trending up, the put option which is sold for 200 rupees would be booking at 160, 20%, and again enter a new leg. So which will be, then the straddle would become an inverted strangle. The losing leg will be at maybe 20-25% of loss. So when it reaches 1.5 times of loss, 50% of premium loss, then the losing leg will exit and take a new position, which will be again ATM. So one side, if it is a one side movement, there will be a leg which will keep on rolling up, and the losing leg will roll up after 50% of premium loss. So why I kept 50% is it is not too small, not too high. You can keep 70% or even 100%. By then the put legs should be earning for us. So this is one way of rolling up and down. It works most of the days. Sometimes when it is very one side trending market and VIX is rising, then we lose on such days. Otherwise, this is also a good strategy which can be looked at. Fourth variation of short straddle is we can use legwise SL based on technical indicators. I currently use three types of technical indicators, or two types, and in RSI itself I have two variations. So what we could do is, say if you look at an RSI based straddle, it is better to enter the straddle when the RSI is between 40 and 60 or 35 and 70. So that is the range when the RSI says that the market is not very one-sided or volatile. And at that point of time, when you enter a straddle, we can expect it to be a safer, low volatility range. And then what we can do is, in a 3-minute time frame, I tried 5 minutes, it is a little late for an intraday play. So 3 minutes is good. So if you keep a range of 60 and 40, you can keep 65 and 35 as your stop loss RSI. If you keep it to 70 or more, your stop loss hit will take more time. By then, the winning leg will not have contributed much. Losing leg would have damaged a lot. So I was in my back test and all tests that I did, I found it is comfortable to enter between 40 and 60 RSI and exit the losing leg at 65 or 35 RSI. And what happens is, when we do it in 2 sets, the system will exit, and whenever the RSI cools down to, if it goes to 65 and call exits, and when it cools down to 60, again the call will get in. So what happens is, when the market is reversing, you get the opportunity to catch that also, right? So with this RSI, I found it to be really good. But sometimes in intraday, the time is not so sufficient to be profitable all the time. But if you think about the logic, this is really a good logic. You can use RSI. The second variation I use is MFI. MFI is money flow index. It is a combination of volume, and it's a combination of volume and RSI. So this also is a factor which says, which gives a momentum of money flowing in. So here I use 70-30. We can do multiple variations. I am backtesting with different variations. What I find is, like RSI, we should enter straddle between 70 and 30 and keep 75 and 25 as the stop loss. So it behaves similar to the way RSI straddle behaves. And this is not practiced by many people, but if you try, you will like it. It's really good. So it catches the one side movement, it catches the non-directional movement, and it catches the reversals also. So probably this can be explored. So next,
RSI spot or the option we are talking about here?
I take the futures. RSI you will not get for spot. I take for futures. Sorry.
Okay.
And it works well in Bank Nifty than Nifty.
Okay. There is one more question. Do you want to take it now or later?
I can take it now, or like this is the last slide. Probably 2 more strategies I'll finish, then we can have a Q&A.
Okay, sure.
Yeah. So the next strategy is, the next variation of our strategy is delta neutral. So this is done by many of the large houses. The idea is just to capture theta, and it is done positionally. Intraday is not very popular, but yeah, we can do it in intraday also. You can adjust with options, or you can adjust with futures. How we can be delta neutral is, if market is moving one side and the delta is increasing on losing leg and decreasing on the winning leg, beyond a certain point of time, it will start giving loss. So how do we adjust it? Is selling, say for example, if market is going up, C will be losing and P will be making a profit. So beyond a certain level, the overall straddle will be in loss. And to continue to neutralize the delta, we sell another put option, maybe ATM, or we choose what delta we want to sell and we sell it. So then again, delta becomes neutral. So why we do delta neutral is irrespective of the movement of the underlying, there will be not much variation in the profit of the strategy. So that is as long as you maintain it to be delta neutral. But when to neutralize is an art. So it comes by experience. But by simple rule, what I follow is when I adjust with futures, I keep 75 delta, and minimum size has to be at least 5 or 6 lots. Less than that, if you adjust with future, it will be very late to adjust. By then, the straddle will get into loss. So if you have, for example, let me explain about time bomb F futures. It's a weekly positional strategy where what it does is it takes 10 x or 10 sets of straddles, same strikes, same straddles, 10 lots on Friday morning. Okay, so what happens is when the delta breaches by 75 point plus or minus, a future gets in to neutralize it. And then one future is 75 quantity in Nifty, and future delta of future is 1. So one lot is 75 delta. So when the straddle, when the 10 lot straddle is moving one side and it is breaching the delta of 75, then this future comes in. And if the market continues to move in the same direction, then another future comes in if the delta is going to 75 again. If it is reversing to minus 75, then the future which was traded exits. So that's how the adjustment is done. And over a period of 1 week, we would have gained maximum possible theta from this setup. If we don't do this future adjustment, then it is a game of hope. When market goes one side, we hope and pray that market should come down to give us profit. When you have future as your adjustment vehicle, then you can be assured that you will not get into a major loss. And if it goes beyond a level, the strategy should exit from its maximum loss. So I find it to be mostly successful. The win rate is very high, but at times when market moves 300 points up and 300 points down and another 300 points down in the same week, then it fails. So I put it on paper trade for quite some time, maybe 4 months or so. In that 2 weeks, it failed, which costed a good amount of money, maybe about 50K, around 100K in total. But every week it makes about 50K to 75K if you look at the paper trade results. And in this, it is not trade intensive. It takes a straddle on Friday and exits the straddle on expiry day. And future adjustments will be 1 or 2 futures throughout the week. I mean, every day, the maximum number of futures would be 3 to 4 and not much. On Wednesday and Thursday, because of expiry days to expiry, the delta move will be high and future in and out will become more. So this is a good strategy where we can play delta neutral. And the last type of straddle variation, or the 6th type of variation for today, is entering in bulk and exiting in staggered manner. So how we can do is, say, we can fix timings, say 9:15, 9:30, 9:45, 10, 10:15, 10:30. Maybe we can keep 5 different time frames and keep entering straddles at those time frames and fix 20% or 30% or 40%, 50%, whatever percent we want in different time frames as strategy, as legwise exits, and leave the straddle. So it would average out over a period of time if it is alive for all the 5 straddles to enter. By end of the day, it should be profitable. This is one way of doing by staggered staggered entry. The staggered exit is you enter 5 straddle at once and keep legwise stop loss of, say, 25% for the first exit and 30% for the second, 35, 40, 50, 60, 70, whatever is comfortable. So, all 5 straddles will have different SL points. So we will, even if it goes directional or if it reverses, the winning rate will be slightly better. And when the stop loss is higher, say 40, 50, 60%, we can extend it with another leg. Say if market is going upside, if it is a 5 lot straddle, first, second, third gets exited with 25, 30, 40 percentage stop loss. In the 50% stop loss leg, probably after squaring off, you can sell another ATMC, because Nifty doesn't move beyond, say, 300 points a day. That's very rare. If it moves, then we exit. But if it mostly it doesn't move beyond 300 points. So when we do 50% or 60% stop loss replaced with another leg, probably it would cool off, and we will get some bit of theta for that strategy. So that's a way of looking at entering in bulk and exiting in a staggered way. So these are some of the variations I thought we could discuss today, and we can have a question on any of these, or I have one more slide, or two more slides. Okay, fine. We can have questions around it, which will be better, I think. RSI of spot or CEP. Yes, Raj had asked a question. In RSI, one variation is on the future price. The second variation is I'm backtesting one more, which is 60 RSI of option itself, ATM option itself. So entry will be if the RSI of option itself is 60 and below, and exit will be if it reaches 65 and above. So this is a variation which I am trying. Ganesh has asked a question. When using futures to be delta neutral, are the losses MTM? So how much to keep as buffer in strategy 5? So for strategy 5, delta neutral with futures, it is a overnight strategy that I spoke about, or the positional strategy, and it requires full margin. So 10 lots of straddle would require about 16 lakhs, and maximum futures used for adjustment will be 9 lots. So in total, it could be around 31 lakhs or 30 lakhs or 31 lakhs. That's the maximum you can keep. You can expect for that strategy. If you buy an OTM call and put, maybe 10 rupees options or something, probably your margin will come down to 22, 23 lakhs. What is the maximum capital needed for time bomb, and also how are the backtested result? Time bomb future adjusted strategy, I don't know. I had backtest results long time back. I can run one for the last 1.5 years. TT has data from Jan 2020. So I can run time bomb future and share that. The same future-based adjustment on an intraday basis is Minesweeper, Nifty and Bank Nifty. I would personally prefer Nifty because the equity curve is quite smooth, not much of DD. Bank Nifty gives high return, high risk, and some months it is highly profitable and some months it is loss in Bank Nifty. Why futures in delta neutral strategies? We can go with ITM options so that it will cost less STT. Time. Okay. See, delta neutral strategy is it's an existing strategy which many people use and adjust with futures. So that is how
Are you there, Prof? We are not able to hear you.
try ITM options also. So time bomb for both Nifty and Bank Nifty. See, the difference which I have in time bomb and Minesweeper is time bomb X is it takes 10x straddles, and when the delta is not balancing, it squares off one leg from that. Say it either squares off CE or am I audible?
Yes, we lost you in the middle, but now you are audible.
Okay, sorry. Okay, fine. So what I was saying was about time bomb for both Nifty and Bank Nifty. I have two strategies. One is Minesweeper, Nifty Bank Nifty, which is an intraday delta neutral strategy, adjustments with futures. The other strategy is Time Bomb X and Time Bomb Z, that is Nifty and Bank Nifty. So that takes 10 lots of straddles. And when the delta is imbalanced, either CE or PE squares off. So it becomes 9 CE and 10 PE, or 9 PE and 10 CE. And whenever market moves up, it will keep squaring off CE to neutralize the delta. If whenever market comes down, it will square off PE to make the delta neutral. This is a good way of adjusting to the delta. But what I find is the ROI is not very attractive. When you put 14 lakhs or 15 lakhs as investment, you get about 3% a month, even on an intraday basis. But still, it is not a bad strategy. Earlier, when I planned 35-36% annually, this strategy looked really good. So now maybe 3% looks very less for us. I tried short straddle based on RSI, similar to the one you explained, but did not get good result. The range that you used is 40-60. 40-60 for entry is fine. How did you manage the exit and re-entry? If you have to use it in two sets, only then, after it exits at 65, and when the RSI cools down to 60, the CE will be coming in again. And by then, if the market has moved significantly upwards, it will become a strangle. So you will have a better opportunity. If you could check Pegasus 1 and 2 backtest, what do you call, free deployment paper trade of Pegasus 1 and 2, you will find this. It starts with a straddle and enters, exits. So that's how it works. But RSI is also not very fast indicator. Okay, so sometimes by the time, for example, if the straddle is taken when the RSI is 40 and 60, right? If it is taken at 42, by the time it goes to 65, the CE would have lost more money. So such things are also there. But at an overall long-term basis, if you run a backtest for 6 months to 1 year, it is decent in terms of its Sharp and DD, etc. Not as good as DW, daily wages, or ANT. These are extremely different. I don't know how. But from traditional straddles perspective, this RSI-based strategy is good. Which results are better, Time Bomb or Minesweeper? I think Minesweeper is better. Minesweeper is much better. The ROI is much higher. Capital is also higher. I have made a Minesweeper Bank Nifty with hedged, with hedging within itself, which will cost lesser capital. It is I shared with a couple of people in the group to just to do paper trading. So I can share that link. You can see how is it. Its performance. Maybe the capital will be a little lesser. Isn't using ADX or VIX a better option than using RSI? ADX I have not used much. As I told you, I'm a little poor in technicals, but still trying to learn. ADX I have not used, but VIX is definitely a better option. But how to use VIX is what I was thinking. When we get into option selling, if VIX is going up by more than 5% in a day, probably we should exit all the positions. And if people are playing with strangles, then it is a definite exit if VIX is above 5%. If we are playing with straddles, probably we can wait till 6-7% of VIX up also. Especially if the day is Friday or Monday, it's better to exit when VIX goes above 5%, and we can re-enter when it comes down. So I wanted to code this in the strategy itself, but VIX was not available. VIX was not available until March or February. I'm not sure. And for Bank Nifty, IV is a better indicator. Sometimes Nifty also behaves like Bank Nifty. So I'm looking for IV as an indicator. But good idea to have VIX for exit. Krish, 70 and 30 was exit criteria. Used two sets, one for CPE. Yeah, so 60 to 70 is slightly, I tried this also, 40-60 and 70-30. 10-point RSI on a 3-minute is also quite steep. So I tried 60 to 61, 62, 65. I find 65 to be better. 40 and 60 to enter, 65 and 35 to exit. So even if it takes more trades, it is better. The loss is lesser. Considering VIX and current margin requirements, which strategy among these has better average ROIs? I find daily wages and Ant 200 are better. Ant Nifty is better than any of these strategies, but it is not good for everybody. It requires strong emotional control, because the number of trades it takes and number of positive, negative counters it takes every day. Scaling it up will need a little bit of guts, but there are people in this group who are playing 5x, 10x, 15x, and still managing it. So some bit of emotional control has to be there. Then daily wages is a good option, if you ask me. A combination of daily wages, model 1 and model 2 is really a good option. And in this straddles that we spoke about, 6 types of straddles or 7-8 types of straddles that we spoke about, we can have a mixture of these in one strategy itself. If you look at magician secret sauce strategy that I have, it has a mix of overall strategy level stop loss. It has one straddle is at strategy level stop loss. Another strangle, not straddle. Strangle is at fixed stop loss for each leg. The third strangle is on third model, roll up and roll down. So I've combined 1, 2, 3 and put it into one strategy. The sharp is good, returns are good. I'm evaluating an ATM straddle for all the 3. I have the same strategy with ATM straddles as well. So it is pretty decent. The performance is good in the paper trade. And backtest results, whatever I put, I got some 5 results with blank output. I need to run it again now. That's where it is. Considering VIX and current margin, okay. Which all strategies you deploy every day and you love it? I see, if you look at my strategy list, I would have about 200 plus strategies, of which maybe half would be crap. But the remaining half, I like each of them for different reasons. The only issue is I don't have so much capital to experiment everything. So every week I keep 1 or 2 strategies, increase, decrease multipliers, and I keep modifying. But my strong advice to serious traders is stick to one strategy, play for 3 months. You will definitely not regret the decision, whatever strategy it is. Before deploying the strategy, see the drawdown, see the backtest results, at least for 6 months to 1 year. If the ROI in the backtest results say 15%, you expect 50% or 60% of that. And if the drawdown is say 10%, you can expect up to 20% or more than 20% of drawdown. If that is mentally set in our mind, then you are good to go with that strategy. But running the strategy consistently is really required to be convinced about running it. Otherwise, we become discretionary trader, hopping from one strategy to another, and to the bad luck, we would be, the time we deploy the strategy, that day it would get into a loss. Then we go to the next strategy, even that would get into loss on that day. So if bad luck has to hit, it will hit in all the strategies that you hop. So stick to one strategy which is back tested and has decent results, then that should never disappoint. That is my personal experience, and that's what I've seen. So any more questions? Okay, so let's go to next slide. I'm sure many of us are doing this, but still, for the benefit of all, let me say how to use trading capital and what is the optimum usage method most of the leading HNIs and traders do. For options trading, there are some people who chat with us saying, I have limited capital, I want to make profit. People are expecting 10 to 20% of profit with 50K capital. So that is possible only if you are very sharp in catching direction and buying options. Otherwise, it's very difficult. So I kind of discourage such people and say, don't put your hard-earned money into trading. It's a high-risk game. For people with at least 5 lakh capital, it is advisable to trade in FNOs. The best is to mix 3-4 strategies which are not correlated, so that if one strategy loses, the other wins and the other is neutral. Your drawdown of a day will not be extreme. If you have correlated strategies and all of them fail on the same day, then that would be a bloodbath. So if the loss goes beyond 2% a day, then it's very difficult to come back. Emotionally, we will not trust the strategy. So second is cash in trading account does not grow. So the amount of money that we keep in trading account as cash itself, it earns no interest and it is there just like that. So the best idea is to keep collateral margin as much as possible, so that the original investment will keep growing, and that with the pledged margin, we can make use of option strategies. Since we are playing intraday strategies mostly, cash component is not required. Only for MTM or buy option buying or hedging, you can keep a small amount of cash as balance. So investment options, what all can we look at as an investment option? So there are different kind of people who love to take higher risk, lower risk, medium risk, etc. For low risk players, instrument like liquid Bs, which gives about 4% a year, gold Bs, which does not grow or decline but suddenly grows based on global movements. Third option is Nifty Bs. It is as good as buying all 50 Nifty 50 shares. And Nifty, I've not seen Nifty going down year on year any year. Most of the year it will be always on an uptrend. So even when 2008 crisis came, or Corona hit came, or demonetization, or any of these events, whatever it went down, it retraced. Since it's an investment, we should not bother about the portfolio going down or up. And in any of these investments that you do, you can still do a covered call and get rental income. Junior Bs is nothing but first 100 of Nifty stocks. Then there are debt funds, SGB, Bharat Bond. So these mutual funds and all these funds are not accepted by all the brokers. Some brokers will put you into a spin, and it's tough. But if you have a habit of SIP or saving money through these bonds and funds, even that can be pledged as collateral, and that margin can be used for trading. Medium risk instruments are large cap stocks, which cannot run away, blue chip stocks. So you will have good growth, and probably you will have good dividend also. High risk instruments are mid cap and small cap stocks. Not all the stocks will have good collateral margin, but still some stocks can skyrocket, some can tank. So it's for high risk players. One can diversify these and then bring a collateral margin. So for the first low risk type, your collateral margin will not have much fluctuations, but high risk type, your collateral margins will have fluctuations based on the underlying or original investment changes. So, but whenever you do collateral margin and trade, your FNO trading should not get into loss. It has to be profitable. So if it is getting into loss, generally it happens when you play with futures without hedging overnight positions, and it goes into a bigger loss. Broker would sell and liquidate our asset and sell it to meet the pay-in obligation. So that is a risk that is there in collateral margin. The entire investment also can get wiped off. So an ideal plan, I thought, should be around 36 to 48%, 3 to 4% a month. And anything above is a bonus and to be kept as a reserve for bad times or reinvestment. Power of compounding is underrated in the trading community, but that is that's a very serious and important topic. Probably I can request Pratik or someone in the group who earlier spoke about power of compounding. It's a very interesting topic. So let's go to the next slide. What has Algo done to me? Out of emotions, earlier I used to fix stop loss and keep editing the stop loss and end with loss the day. So what has Algo done is out of emotions. Even I'm not 100% emotion free, but still somehow I'm controlling myself, and I've practiced it at least for the last 9 months. So I'm not touching, even when my people at my closed group, say, when you see profit, why don't you book, and why do you let the profit to get into loss, etc. When I say, when it is a systems trading and it is designed this way, if it has to happen, it will happen this way. But on a long-term period, the results are positive. So I want to stay away from screen time. I want to let the algo do its job, because I put a lot of mind, effort, and research in building a strategy, testing it, and after that I should not tamper it, right? So that is the idea, and I'm trying to keep my emotions out. Second is limited screen time. If you are a working professional and you are passionate about your work, then you will not be able to spend more time into market. If you're equally passionate in trading, then probably algo trading is the best. You can let the algo do its job, except for TT errors. But I hope TT is a blessing for me, at least. So it should improve as they are communicating through their newsletters. Systematic, discipline, and process oriented. So when you design the strategy after a lot of study, it becomes a systematic approach. There is a discipline. It has its own process. We don't tamper with it, and it works on itself. So it is scalable in long run. So a discretionary trading, decision making based on our intuition, etc. You can do it when your capital is 2 lakh or 5 lakhs or 10 lakhs, but you can't do it when your capital is 20 crore or 200 crores, right? So though I don't have so much capital, I think of trading with huge capital, and how do I behave, or how do I keep my mindset when whatever happens in the trade, assuming that I'm handling maybe 200 crore mutual fund, or 200 crore fund. So how should my behavior be? How should my attitude be? So that will help in the long run. Though I am a small trader today, when I have a significant amount of capital, my behavior, I don't have to change my behavior. I start building it right now. So I would request that. That's how we should think. So think as a big trader, and even 2% loss per day, beyond 2% loss per day is not acceptable. It's better to close the shop if we hit 2% loss on a particular day. Peace of mind when you hit the bed. Yeah. So I have stopped or reduced positional trading, overnight positions. This intraday is doing much better. Shop opens in the morning, closes in the evening, and then you're done. Whether profit or loss, the day is done. So that's something good happened. Let's go to the next page, the next slide. So a little bit about risk management. Most of the strategies that we do, we define the risk reward. A simple thing like a short straddle, we are defining risk as 25% of each leg. So if the premium is 400 rupees or 500 rupees, maximum of 100, 200 rupees, which is 5,000 rupees, is the loss that we have defined. So we can define most of the strategies we define leg-wise stop loss or strategy-wise stop loss. In my strategies, I keep sometimes I keep 1%, or in some of the strategies where there is a huge MTM fluctuation, I keep 2% as the strategy level exit. So if the strategy cost is 2 lakhs, I keep stop losses 4,000 rupees. So that is how I've kept the risk management. Backtest for 2 years, we may expect 70. This I spoke about. Do not rely on backtest results. The difference is backtest is on 1 minute candle close, and within that 1 minute, whatever spikes came in and cooled off, we never know. But in live market, even that spike will be captured by the algo, and it will square off the position. After squaring of the position, it would come back to the same price. So backtest is not 100% accurate. It is just an indication. Backtest is to be used to see the equity curve. How is the curve? Does it have too many ups and downs, or is it smooth? That is how we should look backtest as. And second is, we should see the underwater chart in the backtest. So how much of maximum drawdown the strategy has had in the past 2, 3, 4 years or whatever. And we should be prepared for a 2x of the drawdown. If the strategy says 5% drawdown in backtest, we should be ready for 10% drawdown, and it can happen soon after we enter the trade. So that's how our mind should be set. For every strategy, I keep 2% as the maximum stop loss. Conservative people can keep 1% for the overall portfolio. If your total capital is say 30 lakhs, You cannot risk more than 60,000 for a day. And in a day, if you lose 60,000 rupees, it is better to exit, close the shop, forget about it. Next day, next couple of days, we'll recover it. Waiting for that to recover and get back is really difficult unless you are the creator of the strategy and you know how exactly the strategy works. As long as you are not the creator, you are a subscriber, or you are partially aware of the strategy, better to hold a 1% stop loss at portfolio level. For all overnight positions, always keep a put option. Never have naked overnight positions. One bad event can take away, if a gap down of 5% opens. I think many people do this overnight reusing capital, selling straddle. I did that back test. It is little scary. It earns for 15 days, and one bad day it will lose 5 days or 6 days profit. And one real very bad day, very big gap down days, we will have irrecoverable loss. So it's not recommended to have overnight positions, especially on the downside. Upside is still manageable. If at all you want to use idle capital for overnight trades, buy a put option, monthly put option, 5 strikes away or something. At least the capital will not become zero. It will be hedged at some point of time. The loss will be limited. Do not deploy more than 75% of your total capital in a day. 25% might be required for emergency or crisis management. Never borrow and trade. The last point is very, very important for people with lesser capital. Looking at paper trade results, looking at the ROI charts and the graph, people think with 2 lakhs I earn 25,000 a month, and in a in a year I make 100% and all that. So it is all fancy. In reality, it will not be so. And never borrow and trade. It will never give peace, or it will disturb you the whole time. Please never borrow and trade. And yeah, that's about it. If my Twitter ID and Telegram ID are given in the last page, you can contact me on Twitter. I mean, I'm anyway active in the group. So that's about it. Any more questions? Or we are open to have a coffee chat. We can do some brainstorming and discuss. Jitendra had asked, that's a good, Nagarjuna had asked why most strategies takes ATM straddle based on future price. Future price is the right way to do, because options go behind futures. Options don't go behind. Option pricing is purely based on futures. If you do a synthetic option, say sell ATM call and buy ATM put, that value that will be as good as the future movement. So option prices always go with future, not with the spot. But what happens is now very recently, if you see, the variation is very high, maybe 200 points difference, or more than 200 points difference between spot and ATM. Because of that, most of our strategies are hitting stop loss on upside, and downside gives loss, and all that. Most of my strategies I've moved to delta 0.5, which means it is neutral to both up and downside. Still, we will not have a pure balance, but it's okay. We'll have to manage with that. Which is the best daily wage model, model 1 or 2, in terms of very low drawdown from the live auto trading so far? Model 1 has leg-wise stop loss, and model 2 has strategy-wise stop loss and not leg-wise stop loss. If both are deployed in same multiplier, you kind of balance the total strategy. If you do only one, then it has its own advantages and disadvantages. Mostly, if you ask me, combination works better. Anybody else in the team who used both the strategies together can also pitch in and explain. If future is not the same, then people will hedge for free money. I didn't understand this. Model 1 has better ROI. Yeah. And it's a difference between MIS and normal. If you see, the difference is about 145k and 185k or something. 40k is the difference. But in normal, you can play until 329, right? So you can have two more entries or one more entry after 3. And the decay, premium decay in between 3.5 and 320 or 325 will be higher. So normal will give more profit compared to MIS. And in MIS, some of the brokers push us to square off before 3.5, 3.8 or 3.10. So normal, you have time till 3.25 or 3.30, 3.29 maybe. And keep 5-10 minutes buffer for TT errors. In case it doesn't work, then manually you have to square off. So I kept 3.20 as the closing time for normal orders. What are the trends or changes you have noticed with the new margin changes? With the new margin changes, it has become easy or not so difficult for big money to game the market. Say earlier, if you needed 100 crores to move 20 points in Nifty, today you can, with the same 100 crores, you can move 40 points in Nifty. Say that's how the liquidity has come down, or the volume has come down compared to the earlier model. I mean, earlier leverage, when there was huge leverage available. That's the difference I'm seeing. So though the VIX is so low, and if you draw a trend line, or if you draw a high and low of a day, it would not be a big difference. But within that high and low, within 5 minutes, 3 minutes, you will find spikes up and down. So that is possible. I mean, that is made possible because the volume is low and people with slightly bigger money are able to move the market up and down. Earlier, it was very difficult because you needed more money to move the market up and down. Which strategies would you recommend in combination for keeping the equity curve smooth and free of large downs? I don't know answer for this, because in my set of strategies, I have so many strategies, and I myself am not very sure of this. I think I'm not able to help here. For smaller capital, probably DW1 and 2. 1 lot is good, or 5 lots, whatever, or Ant 200 is good. Nifty seems to be pretty okay. There is one silly dragon I've kept. It is like Ant Nifty, but it is on price action basis. That is also giving good results. Straddle type 1, 2, 3 in this PPT. So that is also giving good returns. So you run backtest for 3 individual straddle types, and then combine all 3 and see. So that's how Magician Secret Sauce works. So each strategy has its own benefit and disadvantages. So I cannot, if you give me a portfolio of 20 lakhs and say you deploy how you want to deploy, then I still don't have a solution for it. I'm yet to work on it. I will prepare one which I can recommend. Would the current strategies will still hold good with the current market conditions going forward, low VIX and high margin requirements? Yeah, these strategies should, the current strategies that we have should work better. Low VIX means low premium. Low premium means low return on investment. That's all. In March, in February, March, April, if straddles were giving a monthly return of, say, 20,000 rupees for one straddle, the same strategy, now it will give maybe 10,000 rupees or even lesser with the same kind of performance, because premiums are half of what it was earlier in March, February, March. And now I wanted to pass this message. VIX has come down to its lowest levels. The standard VIX is around 14, 15, but now I think it has come down even much lesser than that to maybe where is it now? It's at 12. So it can go to 11 maybe, but it has to retrace to 14 or even higher. So for the next 1-2 weeks or 1 month or so, we can expect VIX to rise up, which means all our option selling strategies will have difficulty. Just what do you call, caution that I am sensing, because VIX can't keep going down beyond 11. That's the lowest, or sometimes it has gone to 9, but I don't think it will go to 9 anytime soon. It has to come back to 14. Whether it will go to 9 and then come back, or it will come back now, we don't know. But be cautious is what I wanted to communicate. No, SL will save. Okay. Question from Stefan is, amount of spikes in the market has really gone up, hitting SLs. Crazy markets. Not sure whether to keep or not keep system SL. I agree. A lot of strategies keep getting leg-wise SLs very frequently. But when you enter at 9:15, 9:20, or 9:30, and if the SL is not hit till 10, 10:15, then that day will be relatively easier compared to days when SL hits much earlier. So the strategies which start from 9:15, 9:16, 9:18 to 9:20 are suffering because in the first 15 minutes, there is a 200 point or 250 points up and down in 3 minutes candle itself. So that will eat away all traders like us. It'll hit SL both the sides, and all of us will be out of game. And then the game really starts. So we can start after 9:30, 9:45, even leaving the initial initial half an hour's theta. It's still okay. My SLs got hit around 132. That is bad luck. We can't do anything. That is tough. After the strategy runs after 11, 12 o'clock, and then if SLs are hitting both the sides, then that is out of our control. It's not gamed. It's possible, probably. Bad luck. And in the pocket money strategy, I've noticed that between 2 p.m. and 3:20 p.m. it makes money. So it's not worth starting from 9:30, 9:15, 9:30 till 2 o'clock. Whatever it does from 9:30 till 2 o'clock, it earns and loses and earns and loses. Number of trades are high, and SEBI fees, turnover fees, everything is high. So all that can be avoided. Starting at 2, ending at 3:30, 3:20 is still meaningful in pocket money series. Yeah. So any other question? Is voice not enabled for others? Can others talk, or it's not possible? Oh, I've got 3 questions in Q&A. Okay. Nilesh, after September 21, full margin will be required. Hedge to get margin benefit will be better idea, as 2,000 points away will also cost 10 rupees per leg, means paying minimum 500 per day for margin of 80K will be better idea. Personal loan at 13% will also not charge this much, right? Yes, that's the way to go. So some of the strategies I started making in normal itself, because once SEBI had decided this, I don't think there will be a step back, though there are people writing in Twitter and forums and so many petitions. I don't think they will reverse the decision. We have to accept the fact that a straddle requires 2 lakhs and hedging it will make it 1 lakh. We should just set that in mind and move on. What is the max capital required time bomb? And how are the back-tested results? I will share that, Pratik. What another variation I have said, short straddle, leg wise SL, and leg wide profit also. Yes. Okay. So any other questions, anybody? Okay, so I think we are good. We have spent. I feel we have spent good amount of time, good time, quality time, and you guys can share what I have to improve, and we can possibly have a frequent catch up like this. But I would recommend, if people, there are very sharp minds in this group. I've seen. I'm thinking whether to name or not. If I name some and miss some, I don't know. Like people like Pratik, people Krish, Bhavesh, Vijay, Arjun, Jitendra. Am I missing some people? Very sharp minds, and Anand. Yeah, so very impressive, and I'm happy to be part of this group. and together let's make money. That's my tagline. Let's make money. Thank you so much for your time, and we will catch up next time. Thank you.